Thanks everybody for being here. This is the dry bulk panel, which is by far the best panel, so buckle up. I have some good friends and clients, but mostly good friends here. So what I'd like to do first is we're in an environment where dry bulk is probably doing maybe better than people expected and has been doing well for a while. Like most of the world, things are harder to analyze and harder to predict these days. Dry bulk is one of those categories. So what I'd like to do, and there's been a lot of activity in dry bulk, whether it be the market, consolidation, other things, maybe just to level set, we'll go through and have Peder, Tasos, and Ted go through and introduce themselves, what company are they from, and maybe just quickly, how would you differentiate your company without a huge sales pitch, but differentiate your company in the landscape of dry bulk?
Yeah, I'm Peder. I'm the interim CEO and CFO of Golden Ocean. We are the largest Capesize owner among the listed peers, listed here in New York, in Nasdaq, and Oslo. Market cap currently around 2.6 billion. We own a fleet of 94 ships, of which 60 ships are scrubbers. Now are Capes, with approximately 2/3 of those scrubber fitted. We have 34 Panamaxes and an average age of just above 7 years, which means that we are sailing in a significant premium to the market rates. Having that modern fleet, we have no investment requirements. We have no capex requirements, which means that, and we have a balance sheet that is approximately 35% leverage, meaningful leverage, but still very conservative, which means that all the money we make in the market, we intend to pay out as dividends. We've paid around $1 billion over the last 3 years. I think to differentiate ourselves in the market, I think we are the only large dry bulk company listed here in New York with a significant Cape exposures. We are predominantly Cape exposure, and with the market outlook and not least the supply side being very strong on the Capes, we feel that's the place to be.
Hi everyone, I'm Peder Allen, CFO of Genco Shipping and Trading. Genco, we're 43 ships. We have a barbell approach to fleet composition. We own Capes and Supramax vessels. We like the upside potential of Capes, whereas we balance that with the relative stability of the minor bulks. From a capital allocation perspective, we differentiate ourselves through our capital structure, which we've paid down about 75% of our debt in the year to date over the last 3+ years. We have a 7% net loan to value, a sub $10,000 per day cash flow break-even rate. We have over $300 million of revolver availability that's undrawn. So if the market goes up, we do very well. If the market goes down, we're able to really take advantage of that situation with our balance sheet, with our capital structure. We've also paid 19 consecutive quarterly dividends, which is the longest streak among the peer group.
Hello everybody, I'm Tasos Aslidis. I'm the CFO of EuroDry Limited. We're a smaller player in the market than my peers here. We have 13 vessels, 8 Chinese-built Kamsarmax to Supramaxes in terms of size. 3 of those we built ourselves, and 5 Panamax bulkers, Japanese-built, of later vintage, workhorses of the year, still providing us good earnings. We're cautiously optimistic about the dry bulk market, and we intend to grow EuroDry either organically or through joint ventures.
Hi, I'm Ted Petrone, Vice Chairman of Navios Maritime Partners. My title means used to be president. They don't know what to do with me. So Navios, we're a little bit differentiated because we have a diversified fleet. We have containers, tankers, and dry. Dry is about half of them. 76 vessels dry, 35 Capes, 36 Panamaxes, some handies, and a transfer vessel. So to a certain extent, we're on the dry panel, but being diversified allows us to smooth out our risk profile. It gives us cross-sector opportunities. You've seen what we've done in the last year with some of the revenue we've brought in from the long-term contracts on containers. We've rolled them into tanker new buildings. Those have been time chartered out. We don't play the spot market. We play the time charter market, short, medium to long, according to where we are in the cycle. And we're seeing some real good information in terms of supply and demand and other things going around the world. Black swans have actually been positive for us, for the whole industry. So I think we've got a good future going.
Great, thank you guys. So a few topics, and I will go back and forth between you guys, kind of depending on what I think suits. But let's talk about China. China is a topic that's just incredibly broad in scope. It's a big part of the dry bulk ecosystem. I think whether it's dry bulk or other businesses, planning vis-a-vis China is just a really hard thing to do. There's been many phases. There's an opacity about it that makes it hard to plan. There's always some trend or some rumors about stocking, destocking, restocking, what have you. How do you, understanding that we've seen, and I think we have some optimism about the return of China just in a medium term, how do you plan your businesses around China? Because at the end of the day, it is a bit of a risk management exercise. So maybe, Peder, I'll start with you, and Ted, you go next.
Yeah, thank you. I think being in the larger end of the dry bulk space, in terms of ship size, we are extremely dependent on China. Have been for a long time. I think the sort of Chinese planning around Chinese development has been challenging, since there's been very little, reliable data coming out of the country. But we have seen the sort of ghost of Chinese economy collapsing due to debt, high debt levels, and so on, for the last 15 years. But they've kept on going, and they kept on growing. And if you look at the correlation between dry bulk volumes and GDP growth, it has been over time 1.2 times global GDP, driven by Chinese growth being at sort of double-digit levels. We're now seeing them coming down to around 5% or so. But we do not foresee that China will not remain the main engine of the economic growth. We do, however, see that rest of Asia is picking up some of the lack of growth that you saw in China, and India is also a significant contributor. But we are in a situation now in the dry bulk space where we don't really need massive growth anymore. We have a supply side under control. There is a low order book. It's very difficult to get yard slots to build this cycle down again. So we're comfortable with China's situation, and even though they are struggling in the property sector and so on, they're going to deliver significant or sufficient demand for this space to be very interesting going forward.
So we've been looking at, obviously, what's China been doing this year compared to last year. I mean, they're up already. I mean, in iron ore, about 7%. I think coal's up 13%, and grain's up 2%. But the thing you mentioned about it's not just, they may be flat for iron ore imports, but it's a ton-mile issue, right? Because you're getting a lot more iron ore is going to come out of Guinea starting in 26. You got the bauxite, which is really the third cargo for the Capes that I think is actually, it's like a second valet in terms of commodities going out to the east. So I think the iron ores were pretty comfortable on that. On the coal basis, they play the green game, but they're building, steam-powered electrical. And what's happening is that it's part of their defense mechanism to build up more coal. Now, just not China, because if you take India and Southeast Asia, ex-China, out of the 1.4 billion, about 750 million is ex-China, not India. So they're not the only story in coal. We're happy with the ton miles on the iron ore. So we're relatively, and the order book, as you say, is fine. So listen, we've been worrying about China for 15 years, and we're going to keep worrying about it. But I think it's okay.
Okay, great. And maybe I'll flip order here a little bit compared to what I previewed to you guys, but maybe Peder on coal, just Ted covered it briefly. It's part of your planning situation. It's a commodity that I think people are talking about. It's been weak from a politics perspective. It's supercharged in the U.S. It's a big part of dry bulk, but how do you plan around that as well?
Yeah, no, absolutely. It's look, it's 20% of dry bulk trade when we talk about the overall coal trade from a dry bulk perspective. The great thing about dry bulk, it's not just one commodity. We have lots of commodities. So as over time, in the longer term, it's natural for coal to slow down in terms of growth and potentially unwind at some point in time, longer term. But you'll have other commodities pick up the slack. So from a longer term perspective, that's kind of our base case. But in the near term, you know, there's certainly a shift from the east, well, Asia really ramping up more coal imports, the West kind of dissipating in terms of coal usage, so more, you know, U.S. to India shipments, Colombia to China, so longer haul. So it's less of a ton story, more of a ton mile story. We certainly haven't seen a whole lot of investment in new coal plants, like in terms of volumes, but certainly more ton miles, more going to Asia to fuel their continued development.
Great. Switching gears. So energy transition, I think it's almost a cliche at this point. It's so broadly defined. We hear it every day, multiple times. As a recruiter at Morgan Stanley, off the business school campuses, I wish we'd done a better job of recruiting, because I think every associate who joined after business school headed into the power and utilities group and is now going to be an energy transition expert. As it relates to dry bulk shipping, let's kind of get specific. What are the aspects of energy transition that are applied, whether it be technological efficiency, decarbonization? What are the trends that are, if you cut right through it, what's happening to the ship? What are the initiatives that you can do? How are you, and over and above compliance, being proactive as managers and capital allocators, how is energy transition applied to dry bulk? Maybe I'll start with you, Peder.
I think in dry bulk, it's challenging to get the dual fuel story to work. So that, I think, at least for our point of view, it's not something that we want to do, and it doesn't make sense. But there are a lot of low-hanging fruits that we're doing, and we're doing that across the whole fleet. We are sandblasting the hulls. We are using low-friction paint. We are putting on Mavis ducts and all kinds of technological improvements, which gives you 1%, 2%, 3% fuel efficiency gains. And it's low capex, but it's low-hanging fruits, and it's instant effect. For instance, we have now changed all the light bulbs on our ships to LED lighting, giving you, which is just as simple as that, giving you 1% to 2% because you're not running your auxiliary engine that much. So I think that's that, in addition to renewing the fleet. I mean, modernizing the fleet are the most biggest gains, and obviously lowering your carbon footprint is one-to-one with saving fuel costs. So it's really something that we are very happy doing with very low and short payback times.
Okay, so your incentives are aligned there in some way. Tasos?
Yeah, I think I'm glad you asked the question, and I fully agree with Peter's answer. I think for owners, it's hard to take initiative and decide on the fuel of the future or what is the right propulsion engine that would be in the future. So all you can do is take small steps to chip away at the carbon footprint of your company and of the whole world. We're doing similar things that Peter mentioned, from becoming more efficient in our maintenance, which sort of reduces the long-term fuel consumption of the ship, to installing energy-saving devices, paints and the like, changing the bow, the propeller in certain cases, doing retrofits. All of these contribute. Some of these require minimal investment, some others require some investment. But taken together, they add up, all the savings add up, and I think we're going towards the objective of reducing the carbon footprint.
Let's give shipping a little bit of defense here, first of all. You know, everybody knows 2.8% of the pollution, 90% of the trade. If you take the same amount of cargo, there's different studies, but I'll just give you what we're seeing. If you do that and transport it by air, it's 80% more carbon intense. If you do it by truck, it's 15%, and rail is 5%. So our internal calculations are a lot like Peder there. We could probably get 20% of the way there with ESDs, and toll and all that type of stuff. Maybe you do carbon capture, another 15%, and then you have LNG. But we got to get to the next fuel. I think we need a little bit of collaboration there's a lot of vertical between the IMO and individual companies, but we need to be horizontal, because if we're going to go green, in my opinion, we're going to have to spread that cost out to the whole supply chain. If we're going to go order capes that have a different engine, okay, we can be LNG ready, but if it's going to have a different engine, e-methanol, there's a lot of money there. And so we're not saying everybody has to pay for it, but at least they have to have a share in it. I think you have this new fuel, which is going to be low density, low availability. I don't know where you're going to get the gas stations if it's not LNG. So it is an issue, and IMO is trying it hard, but we joined some hubs and trying to do some, we need to spread the information out and be more proactive than and the industry's been reactive lately about this.
The U.S. election is a topic that is all over the U.S. media. It'll certainly be interesting, if nothing else. That's emblematic of just kind of geopolitical unrest, or at least complexity. How do you guys, I asked you earlier about planning for China. How do you plan for trade wars, tariffs, things like that could change? U.S. as an example, but obviously it proliferates throughout the globe. Maybe Peter, I'll start with you.
Yeah, look, there's certainly going to be quite a bit of rhetoric, and it's going to start tomorrow night in the debate. But our ships, they're long, useful life ships, 20 to 25 years. They're going to go through 3, 4, 5 different U.S. administrations. There's going to be tariffs and no tariffs, and they're going to go on and off, and they're going to get taken time to implement over time. But look, we don't really worry about that. We're not really in the business of predicting elections. We can control what we can. That's our capital structure and our balance sheet, and where we allocate that capital. But yeah, it's certainly going to be, there's going to be a lot of talk, a lot of rhetoric. Ultimately, we don't like deglobalization. We don't like trade wars. We're more for global prosperity and free trade. So those things aren't necessarily good for shipping. But again, we focus on what we can control.
No, I think there's a lot of rhetoric, as you say. There's a lot of things thrown out there. But I think the world is so interconnected now, and global trade is we're all interdependent. So I don't think in practice there will be sort of massive tariffs that can be imposed. I think obviously these things have an impact on sentiment, and it's not going to be positive to, on our stock price probably for a short period. Maybe not in the forward curve either, but in real terms, I don't think there's nothing they would plan for, at least.
If I can add something, even if there is an effect, even if tariffs and trade wars create an effect and reduce overall trade or create nearshoring or onshoring, the effects on the different market segments would be different. Containerized trade, finished goods trade might be affected more from nearshoring, let's say, but dry bulk trade might not necessarily get affected negatively because raw materials will still have to travel to their new manufacturing hubs. So, all of this creates uncertainty, which hopefully the low order book and support of the supply side in the near future would enable us to absorb.
Makes sense. Let's talk about consolidation. It's always a fun topic for bankers, but it's usually pretty theoretical. Brokers do a lot of the good work. A lot of personalities become the deal issues, but we saw Star Bulk, Eagle Bulk get done. So there's at least one guy on a boat while we're wearing ties this year at Marine Money. How do you guys think about, do you think that is the beginning of potentially more consolidation, and how do you guys evaluate consolidation, both in terms of your own value and acquisition opportunities? Maybe, Ted, I'll start with you.
Well, we started with consolidating ourselves to put everything under one umbrella. Again, I think it gives us this, you have a negative correlation between wet and dry. You have maybe 30% between dry and containers, so it gives us a lot of cross-segment opportunities. It just puts us in a better position to play the market. And I think the problem with the dry market is the container market is probably the most consolidated of the three. Tankers is a bit consolidated because there's a lot of pools, and that's a consolidation too. But you have 13,000 ships out there on the dry bulk, 10,000 deadweight and higher. And I think it's very difficult. You have a lot of smaller owners, So I think there's going to have to be some, maybe kind of alliances working as we go into this new future between some of us dry bulk owners. Some of us with the bigger fleets can get together and really consolidate and control part of the market.
Can I add a point? I think what Ted referred to is commercial consolidation that has taken place. Ownership consolidation over the years has not proven to be the most effective way of owning ships, except the public markets. In the public markets, and to some extent in the private, but if there is a big inside owner, a big founder, a shareholder, then that creates certain obstacles to consolidation, right? Because everyone has to have this company for his to fulfill his ambitions or his image as a publicly listed CEO and what have you. What is likely to be candidates for consolidation, especially in public markets, are companies that do not have strong inside ownership, like Eagle was, and especially trade below their intrinsic value. So Eagle was a great example of a situation like this, and there was a war, I guess, who is going to get it. Perhaps there is another one that in the public markets that would be the next target.
Well said, well said.
Peter, you want to add to that?
No, I think consolidation is always good, but as Ted mentioned, I mean, it's so fragmented, this market, so you won't really get any pricing power, so that's sort of off the table. One thing that may drive consolidation going forward, I mean, it has always been challenging in shipping because we all like our own ships best. One thing that may drive it is liquidity, because I think the investor market, at least the public markets, are seeking more liquidity and pricing that. So I think that might drive some consolidation, and obviously there is different cost models that we are running with some between ourselves, and I think that can also be some synergies on that level. But I think liquidity is probably the biggest benefit of consolidation, at least in the public markets.
Clear. Let's switch gears to activism, which is kind of related, but it's certainly a trend that has picked up a lot. It's been around for a long time. It's been extremely busy the last couple of years. I would say that there's, my peers and I are spending a lot more time on activism, and I think we had a misconception around more cyclical industries like shipping, like airlines, that they were not immune but less likely to be attacked because they're mostly dealing with an exogenous market cycle. And so, obvious mismanagement is not so obvious, and it's really subjective. But lo and behold, shipping has had its share of activism. Airlines are going through it as we speak, and I would say probably 40% of my time is spent on things related to that topic. So I'll go straight to you, Peter, on this one, and I'll keep the question civilized. I mean, you obviously went through it recently. It's something that never kind of goes away, but what would you say, some of the benefits of going through that, or some of the lessons learned that sets Genco up as you go forward from here?
Yeah, no, so obviously Genco we just went through our proxy fight and concluded with our annual meeting, which we were successful through that fight. But look, it's the nature of being a public company. We have a high free float, over 90% free float. So, that's one of the benefits of being investable. We've worked really hard over the years to set the company up from a capital allocation perspective, from an operational perspective. So we actually look at it as a good thing to be investable. Somebody wants to buy the shares of Genco for all the various reasons, as well as the corporate governance standards, #1 3 years in a row on ESG. So there's a lot of good things. So we're proud to be an investable company. It's something we work very hard at. We've studied various different capital allocation strategies. Every decision we make as a company is strategic. There's a lot of analysis, a lot of discussion behind it, and then we communicate that to the public markets in a transparent way, and then we have discussions with shareholders. And we really enjoy our conversations with investors, prospective investors, where we not only get positive feedback, but also constructive feedback that we can improve as a company and get better, because ultimately we want to be the best company possible. So we really value that. So having substantive conversations with investors is terrific. But in terms of activism, yeah, I mean, it's just how it goes. It's status quo as a public company. That's just the nature of it.
Part of the reality. Ted?
Well, our chairwoman has about 17% company, and which is comforting to the shareholders, right? We have a biggest shareholders 15. We have 2 that have crossed the 5% threshold, all aligned with our management philosophy. They're all long-term horizon investors. So if you align yourselves, with the investors and they agree with you, you really don't have that issue going on. And we've got some support that people would recognize the names immediately. I think if you play the game right, somebody can give it a try, but it isn't going to work if you have the right shareholders behind you.
Yeah, I think it's important again to notice, to underline that if you do the right thing for your shareholders, the chances of facing shareholder activism are minimized. Of course, there is a sweet spot, and communicate properly, as Peter said, the communication is a big part. There is a sweet spot for shareholder activism for things that you cannot really control as a management or the board. If you trade below NAV and your ownership is widespread, then you are an obvious target for trying to for shareholder activism with the possibility of taking over the company.
I think we are a very shareholder-driven company with a strong owner, and I think we are principally against all shareholder-unfriendly protective measures. So I think this is something that we have built up over time, having alignment of all shareholders' interests and treating them well over time, and then obviously having a big owner that is strong, we are somewhat protected from that in that way.
Yeah, understood. And I agree with Peter in the sense that when you're widely held, that has some benefits. It's also a little easier to mount a campaign. If you have a large shareholder, it can cut both ways. It can be seen as, okay, that person is presumptuous that they have control even if they don't have effective control. But if they're aligned in their economic interest and they're active in management, and it's nice if they have deep pockets as well, that can be a deterrent. Maybe a last one, and I'll aim it at the Peter and Peter. Cost of money. Everybody talks about where's the economy going, because interest rates have come down, and inflation have come down a little more slowly. I think we're just in this constant situation or purgatory of uncertainty, but it does feel like things are getting better. And from our perspective, in kind of investment banking landscape, deals are really starting to happen. Financial sponsors are starting to sell companies. The velocity of business has really picked up. And my personal view is that even though money is more expensive, there's a bit of a human psychology that's set in about that, an acceptance to that, and okay, it's higher for longer, I still have to prosecute my strategy. That's my editorial view. But I'd be interested in, when you guys are talking to your boards as CFOs about capital allocation and how to finance things, and whether it's too expensive because interest rates are higher, how are those conversations different from 18 months ago?
I think, we have, and that goes for most of the dry bulk companies, we have been very disciplined in deleveraging over the cycle. We have a very strong balance sheet, so the cash break-even cost has come down, and that's and a lot of cash on the balance sheet. So the sort of cost of capital hasn't really been that big of an issue. I think. We opted for having a meaningful leverage. So we have an LTV of around 35% at the moment, focusing mostly on the cash break-even rather than the relative leverage because the values have gone. But debt is still cheaper than equity. And I think having that manageable leverage level but meaningful leverage is important to make things work. I think it's what has happened at the same time is that margins have come in. Spreads have come in massively, and at least for us, with the size and modern fleet, we have access to really attractive financing. And that has mitigated a lot of the sort of rate hikes that you've seen. We also have been managing our portfolio of floating rates, fixed a lot of this earlier on. So we have about 1/3 of our debt on fixed rates at very attractive levels. So that's not really a topic, but we do intend to keep our leverage on a very moderate level. But we see that it's a really important tool to have when we invest, to have meaningful leverage.
And your point on spreads is interesting because spreads are as tight as they've ever been, and I think part of that is because base rates are as wide as they've been in a while, and we'll see. It'd be interesting to see how those change. Maybe just last one, same question for you, Peter, and then we'll throw it to the audience for questions.
Yeah, absolutely, thanks. No, so at Genco, we've essentially tailored our debt structure around our capital allocation strategy. From a broader perspective, we put in place a $500 million revolving credit facility, 100% revolving credit facility last year, and what that enables us to do is we can voluntarily pay down debt, but not lose the borrowing capacity of it. We obviously contracted our margin as well, given the higher interest rate environment. So when we do get into a situation where we have some excess cash on the balance sheet, we can pay down the debt, and it won't necessarily impact our overall lending capacity, so we can still go out and buy ships on an accretive basis for shareholders. So we've really tailored that structure around our capital allocation strategy.
Questions for the panelists? We're good. Okay. Amazing. Thank you, Peter, Tasos, and Ted. Thank you, everybody.